The shakeout has arrived. The forced liquidation is underway. And right now, as you're watching this broadcast, index funds are being compelled to dump more than $5 billion worth of silver futures onto the market. This is not speculation. This is not theory. This is mechanical, algorithmic, mandated selling that has nothing to do with fundamentals and everything to do with arbitrary index weightings. The Bloomberg Commodity Index is rebalancing. The computers are executing their orders. And the price of silver has already dropped 9.3% in the past 7 trading days. The mainstream financial media wants you to believe this is the end of the rally. They want you to believe the bubble has burst. They want you to panic and sell your physical metal at the exact moment when the smart money is backing up the truck. But I'm going to show you what is really happening. I'm going to expose the mechanics of this manipulation. I am going to reveal why this forced selling is creating the buying opportunity of a lifetime. And I'm going to explain why the fundamentals have never been stronger, even as the price temporarily retreats. Let me give you the numbers, because numbers do not lie. Daniel Golly, the senior commodity strategist at TD Securities, has quantified the risk we are facing. He estimates that passive funds tracking the Bloomberg Commodity Index must offload silver futures, valued at over $5 billion. This volume equates to roughly 13% of the total open interest on the COMEX silver markets. Let me repeat that. 13% of the entire market is being liquidated within a 5-day rebalancing window that began Thursday. This is not normal trading activity. This is a forced unwind that has nothing to do with supply and demand. The algorithms do not care that silver is a critical mineral. The algorithms do not care that China is restricting exports. The algorithms do not care that industrial demand from solar panels and electric vehicles is insatiable. The algorithms only care about matching target weights. And the target weight for silver in 2026 has been reduced from 9% to below 4%. That arbitrary decision by index committee bureaucrats is causing billions of dollars of selling pressure. The price action reflects this mechanical assault. Silver hit an all-time high of $81.66 on December 28th. That was just 8 days ago. In those 8 days, the price has retreated to approximately $72. That is an 11.5% correction from the peak. The headlines are screaming about a crash. The analysts are warning about a bubble bursting. The perma-bears are declaring victory. But let me give you some perspective that the mainstream media conveniently ignores. Silver is still up 148% in 2025. Let me say that again. 148%. This is the best annual performance since 1979. This is a generational move that has shattered resistance levels and established new all-time highs. And yet, a 9% correction over 7 days is being treated as evidence that the rally is over. That is not analysis. That is propaganda designed to shake you out of your position. The CME Group added fuel to the fire by raising margin requirements to $25,000 per contract. This was a deliberate move to squeeze out speculative positions. When the exchange raises margins during a volatile period, it forces traders to either add capital to their accounts or liquidate their positions. Many chose to liquidate. Many were forced to liquidate, and the price dropped further as a result. This is how the game is played. The exchanges raise margins. When the price is rising, they squeeze out the longs, they create selling pressure, and then the banks and institutions scoop up the positions at lower prices. It happened in 2011. It happened in 2020. It is happening right now. But here is what the manipulators cannot change. They cannot change the fundamentals. They cannot create physical silver out of thin air. They cannot satisfy the industrial demand that is consuming this metal at record rates. They cannot undo China's export restrictions. They cannot make the supply deficit disappear. All they can do is create temporary dislocations between the paper price and physical reality. And those dislocations are opportunities for those who understand what is happening. Let me walk you through the fundamental picture, because this is where the real story lives. The United States has officially classified silver as a critical mineral. This designation recognizes that silver is essential for electrical circuits, batteries, solar cells, and medical instruments. It is an acknowledgement that the modern economy cannot function without this metal. At the same time, China has implemented export restrictions that could exacerbate an existing supply deficit. The world's largest processor of silver is now limiting how much can leave its borders. The supply is constrained just as demand is exploding. The demand side of the equation is staggering. Solar panel installations are accelerating globally as nations race to meet renewable energy targets. Every solar panel contains silver. Electric vehicle production is ramping up as governments mandate the phase-out of internal combustion engines. Every EV requires silver for its electrical systems. AI data centers are being built at unprecedented rates. Every server contains silver. The industrial consumption of silver is structural and growing. It is not going away because an index decides to rebalance. The monetary factors are equally bullish. The Federal Reserve has adopted an accommodative stance. Market participants anticipate at least 2 more rate cuts in 2026. Lower interest rates reduce the opportunity cost of holding silver, which pays no yield. The US dollar has weakened significantly, making silver more affordable for international buyers. When the dollar falls, dollar-denominated commodities rise. This is basic economics, and the dollar is falling. Geopolitical tensions continue to drive safe haven demand. The ongoing conflict between Russia and Ukraine shows no signs of resolution. Disputes between the US and Venezuela have escalated. Tensions with Iran remain elevated. Every headline about military action or diplomatic breakdown sends capital flowing into precious metals. Silver benefits from this flight to safety alongside gold. Now, let me address the elephant in the room. Some analysts are suggesting that capital is rotating out of precious metals and into cryptocurrency. A trader known as the White House Whale, who reportedly made $160 million by shorting Bitcoin before the Trump tariff announcement, is now projecting that silver and gold have topped. He claims that capital is moving to crypto. He has $634 million in long positions on Ethereum alone. But let me give you the reality check. Bitcoin is down more than 5% for the year, while silver is up 148%. Ethereum is struggling to hold $3,000, while silver has broken all-time highs. The crypto thesis has underperformed the precious metals thesis by a massive margin. Yes, there may be short-term flows between asset classes. Yes, some traders are rotating between metals and crypto based on momentum. But the fundamental case for silver has nothing to do with what Bitcoin is doing. Silver is a physical industrial metal that is being consumed faster than it is produced. Bitcoin is a digital asset that produces nothing and creates no industrial demand. They are not interchangeable. The technical picture remains constructive despite the pullback. Silver is still trading 17.55% above its 50-day moving average of $61.48. The relative strength index has retreated from extremely overbought territory to a reading of 62, which is neutral to slightly bullish. This is healthy. This is the market working off overbought conditions. This is the setup for the next leg higher, not the end of the rally. The speculative activity in China tells you everything you need to know about where this market is heading. Shanghai Futures Exchange premiums have reached unprecedented levels. Chinese buyers are paying massive premiums over the international spot price to secure physical metal. This signals strong local appetite and tightening global supply chains. The same pattern occurred in London and New York vaults before previous price explosions. When premiums spike, it means the physical market is divorcing from the paper market. It means that real buyers are willing to pay whatever it takes to get metal in their hands. The coming sessions will feature a tug-of-war between mechanical selling pressure from index funds and fundamental buying interest from industrial users, investors, and central banks. The Friday employment report is a key test. Economists expect approximately 50,000 new jobs added. A weak number would reinforce expectations for Fed rate cuts and support silver. A strong number would complicate the picture, but would not change the underlying supply dynamics. Here is my message to you. Do not let the forced selling shake you out. Do not let the headlines about corrections and crashes convince you to sell at the bottom. The index rebalancing is temporary, and the margin increases are temporary. The selling pressure will exhaust itself within days, but the fundamentals are permanent. The supply deficit is permanent. The industrial demand is permanent. The monetary debasement is permanent. This is the shakeout that separates strong hands from weak hands. This is the test that determines who profits from the greatest precious metals bull market in a generation. Be a strong hand. Accumulate on weakness. Hold your physical. Trust the fundamentals. And when the index funds have finished their mandated selling, when the algorithms have completed their execution, when the market stabilizes and begins its next leg higher, you will be positioned to benefit. The smart money is buying this dip. The banks that raised margins are accumulating at lower prices. The institutions that created the selling pressure are now becoming buyers. Do not give them your silver. Do not sell at the bottom of a shakeout. The $5 billion forced liquidation is almost over. The next move is higher. Be ready.